You buy a stock and it takes off immediately. You're up 30, 50, 80+% in the first few weeks. Everything is good. So the question is, when do you sell? How do you know the party's over? Are there things you can look for to identify a place that might be a wise point to begin selling? Well, today I'm going to show you everything. Now, I've got several videos talking about what and where to buy, how to focus on the leading groups in the market, how to find the top 5 or 10 stocks in that group you want to focus on, the patterns that show the stock is likely to make a big advance very quickly, but I don't have a lot on when to sell. And a lot of you in the comments have asked me, great, what do I do now? And there are 2 approaches to selling. One is selling into strength, and one is selling into weakness. And the best traders do both. So I'm going to start with selling into strength, then cover selling into weakness, because I think it is crucial that you understand how to do both. Now, what you're looking at here is a chart of Oklo, ticker OKLO. I've marked the breakout here on the chart, which you can see had a nice big advance in May and June from 25 to 80. Got this in log scale. It shallows in, puts in a nice pattern, has a nice breakout move here in late September, and then makes a tremendous move. The stock shoots up, 130% in just a month. But if you held it for 2 more weeks, your 130% gain turned into a 40% gain, which is, of course, not good. So, how do we know when to sell into strength? In other words, when to get out while the getting's good? And the 2 strategies kind of go like this. Selling into strength means, hey, I've got big profits on the table. I'm going to nail them down, put dollars in my pocket so that if this happens and the stock reverses back lower, I'll have sold some up high. On the other hand, if it does continue to advance, well, I didn't sell at all. I've still got some stock, and I'll let that continue to ride. And the reason selling into strength is important is because stocks that make big advances, especially big, quick advances like this, can also make big, fast drops. And a lot of people don't see it coming. And so what giveth can take it away. A stock that can double in 30 days can also get cut in half in a couple of days. So 4 times I want to sell into strength. We're going to start with the first, which is the largest daily run up. Now, after a breakout move, again, I've marked it on this chart here in this white arrow, I'm looking for the biggest move in several months. So let's look at this day right here. You can see it here on the chart, where the stock advanced 28%. Look right up here. You can see the percentage that moved that day, 28% in a single day. Now, that is well outside of its norm. Okay, so you don't want to sell on the first day, but look, you bought this thing here at 80. It's up to 95 in 2 days. It's at 105. It's at 135. 28% in a single day is a big move. So you've got a gain of 69% in 1 week. Now, I don't care what kind of stocks you're trading. 69% in a week is a hell of a gain, and there's nothing wrong with taking some of that down. The reason we look to sell on some of these biggest daily gains is that when stocks peak, it's generally something known as like a blow-off top. It's an exhaustion peak. So everyone's getting excited. They're all piling in, and it kind of goes parabolic. So it's a nice trend up and then just turns vertical. And that is often what we see near the top. Now, this stock did end up advancing even more. We'll talk about this. So you didn't get out of all of it. But getting out right in here at the close of that day or the open of the next day, right in here, taking partial profits of 65 or 70% in a week. It then fell, 20%. It advanced further on the way. But this is a good place I'd want to sell partial. And my rules are generally to sell a third to a half of the position on the initial sell. Okay? Second time to sell is when you see the highest daily volume on an up day. Now, this happened on the same day, and these will often overlap, okay? So if you see one of these, 2 of them, you might see all 4 of them on a single day. That's usually a good place to sell. But look at the same day we're talking about here, and look at the volume here. Now, this stock was trading, 10 million shares, 20 million, 28 million, 20 million, 13 million, and 63 million shares of stock. So 3 times the average daily volume. Again, it's that blow-off top characteristic where big volume comes in, makes a big, huge move, and it's often an exhaustion time. And I know you may be thinking, Ross, why would I sell there? The stock kept going. Again, I'm not saying to sell it all, but this stock pulled back 25%. It could have pulled back 50 or 100%. I mean, look what QUBT did. This stock breaks out from here in September. You're up 46%, 50% in a couple of weeks, and then it all comes back. So you would be very happy if you had sold some on these peak days, all right? So in this case, we had both of those. The highest percentage up day, 28%, the highest volume day in, when's the last time? I mean, since May. So the highest volume day in like 3 or 4 months. That's number 2, okay? Number 3 is when a stock advances at least 3 times its average daily range in a single session. Again, this happened on the same day. So like 3 of these are hitting. Really, really good time to sell. But the ADR, the average daily range, shows you how much the stock typically moves from low to high in a given day. And this is really important because you're going to trade different stocks differently. If you're in Walmart or 3M or General Motors, I mean, let's just look at them. Like Walmart has an average daily range, if you're in the top right corner, of 2%. Okay? 3M, 2.5%. Then a stock like SMR moves 10.5. OKLO, 10.9. 10% a day. So we want to look for stocks moving in excess of their norm. Now, this ADR here is as of today. If you want to go back, we can look at an average daily range here, average day range. Here it is at the bottom. And we'll go to that big peak day. And you can see if you look there at the bottom left, that number was 7.95. So that's roughly 8%. So the stock moves on average 8% a day. In fact, it was 6% the day before that, but call it 8%. And then on this day, it goes up 28%, more than triple its average. Again, exhaustion, high volume, big price move, really good spot to potentially sell some. And again, this is specific to the stock. So don't just say if it goes up 20% or it goes up 30%, 3 times its average daily range, all right? And the fourth thing you want to look for, and the fourth signal, it's a good time to sell, is a gap up after the stock is already extended. And I'll show you what I mean. Now, this is Energy Fuels, ticker UUUU. It's been one of the big performers over the last 6 months or so. Nuclear's been red hot, and this one is no exception. It's had several nice little buy points along the way. You can see it broke out over here in late July, made a quick 50% advance. It shallowed up again here in August, kind of formed a base, broke out again, consolidated, broke out. But what we're talking about is where to sell. And one place you want to look to do that is on a big gap up when the stock is already extended. So, for example, let's say you'd gotten the stock back over in here on this initial breakout. Okay, did a shallowing move in here. It's coming in, tightening up, shakeout move, comes back, breaks out through at about the $10.5, $11 area right here. And in a period of, 50 days, you're up 150%. And I want you to look at these last couple of days in here, these consistent gaps up. So a gap up is when a stock gaps, meaning it opens higher than it closed the previous day. So it makes a gain overnight. So if you look at one of these days right in here, the stock, let's look at this. So it closed this day, the 10th, here at $21.30. It then opens the next session up here at 23. So it gapped up, in this case, 12%. Right? There's also a small gap up in here where it closed the top of this candle, opens the next day, only about a 3% gap. But notice how, as this stock was peaking right in here, at the end of this run, you had gap up, gap up, gap up, gap up. Okay? That's symbolic typically of exhaustion. You're getting that just FOMO, pre-market, post-market buying. And especially when you get good size gap ups, 5, 10+%, usually a good place to sell some shares into strength. And if you look at these last couple of days here, this final part of the surge, you had kind of everything happening. One, you had big advances. 10% day, a 16% day, a 10% day, just exhaustive blow off, like a 46% move in a week. Now, you didn't trigger your 3 times the ADR in a single session, but you do have, look at the bottom, these highest volume up days. There's 1 there, 2, and 3 in a row. You've got gaps, 1, 2, 3 in a row. You got big, strong moves higher. The stock is getting extended. And if you kind of draw a line to the bulk of this move, when I say extended, what we mean is like it's taking this kind of trail up and sort of holding this and then just sort of turns parabolic and goes up, advances even beyond its current uptrend. And so that as well would have been a nice place to start selling this stock. I'm not saying you would have known to sell all of it right up here at the tippy top. Anybody who tells you they can do that is lying. It's just luck when that happens. But you could have sold some in here, definitely sold some in here, been getting out of this stock. And then if it rolls over, if it continues to roll, you won't really care because you'll have gotten out of the bulk of this at a profit of somewhere in the 110 to 150% range. And again, if it doubles again from here, so what? You're up 150% in 6 weeks. The goal is to get a nice, clean move over a 2 to 8 week period and roll on to the next one. Okay, so that's the 4 places to sell into strength. Largest daily run up, largest daily up volume, 3 times its ADR in a single session, or a gap up after already being in extended territory. Now, the next thing I want to talk about is selling into weakness. I'm going to go back to our OKLO example we started with, and the first and most obvious place you're going to sell into weakness is if it hits your stop loss. Now, again, the idea of selling into weakness is I want to ride this thing for as long as it'll run, and when it turns, I'll get out. So like trend traders, they don't care what the stock does. They're going to hold it until it falls 20 or 25% or 5 times its ADR, whatever metric they're using. They want to catch the bulk of the move. They're willing to give up the first quarter and the last quarter to ride the thing up because you never know when it's going to be an NVIDIA that runs 800 or 1,000%. The downside of that is you're always going to take a big haircut on your gain at the end. If you're up 150% and the stock falls 25 to get you out, it's not like your 150% gain came 125. Your 150% gain is going to be more like a 50% gain. So you want to sell some into strength and get out of the final on weakness. All right, so where to sell? Number 1, again, the initial stop loss. So in this case, we're risking, if we bought it here on this breakout, stop at a swing low, would have been about a 15% risk. This is a wider one than typical. Normally I keep it around 10, but whatever your initial stop loss is, never move it, never adjust it, never say, wait, I kind of should have loosened it up. No. You're never going to think clearer once you're in a trade. Always respect the place you said you would sell before you got in and never move it. Now, just so you know, what I do is typically drag this stop up manually along the way, and here's how I do it. So you buy the stock again, here at this arrow on a breakout. It makes a nice quick advance, okay? So this one's up 78% in 12 days. Now, I would have been selling some in here into that strength for all the reasons we covered earlier. Big up day, 3 times ADR, high volume, all that. But then I'm still working my initial stop down there where it was. And when I start selling, I'll generally bring it up to back to break even. So I'm not going to lose any at this point. I'm up 70% in a week. I'm not going to lose money on the stock, okay? Now, what will generally happen after stock makes a big move, and this is something Minervini talks a lot about, is do what's known as a natural reaction. When a stock advances, in this case, 75% in a week and a half, 2 weeks, heads up, there's going to be some people like me who are going to take some profits. You need to let those sellers get out of the way. And when they all take profits, it's going to pull the stock back a little bit. This is a dip, a pullback. He calls it a natural reaction. Now, if the stock is still in play, if the institutional buyers and buying pressure is still on, they should step in, buy the stock, and push it out to new highs. So after a natural reaction occurs, what I want to then see is for the stock to then break out and make new highs. So if it comes back right here, this day, once it makes a new high, corrects, breaks through that high, At that point, I am raising my stop loss to the most recent swing low, so the bottom of that natural reaction. This stock, after doing that, began consolidating almost immediately. 1, 2, 3, 4, 5 days in here. Breaks out, begins the advance. At this point, I'm then going to raise my stop loss to this swing low. And my sell on weakness would have been here when it finally rolled over and hit that stop loss. So this is what I like to do with my stop. I drag it up as the stock goes up, consolidates, breaks a new high. Each time it consolidates and runs, I'm going to drag it up, and that way I'm just going to ride the thing as far as it will. And when it, if and when it finally reverses, I'll be out. Okay, so that's number one, when it hits either your original or your raised stop loss. Another place to sell on weakness is if the stock closes below its 21-day exponential moving average. And I'm going to turn this on here. I'm just going to put this blue 21-day moving average. And my analyst, Jean Fade, and I have a saying here, that's nothing good happens beneath the 21 EMA. Now, again, if you're looking at a Walmart or an Apple or a Google and a stock you're trying to hold for 6 months or 2 years, ignore this. I'm talking about breakout swing trading, looking for those nice, quick 30, 50, 80+% bursts, and I just want to ride that initial 2 to 8 week wave. During that explosive phase, the stock should hold and remain above this 21-day moving average. So here, when it closes below it, I am going to exit the stock. In this case, it would have also hit my stop loss, so everything's said to sell. And if we go back and look at some of the big winners this year from these breakouts, I mean, notice that they're going to hold above the 21 for the growth phase here. I mean, look at UEC, just hugged that thing the whole ride up. I mean, look at the explosive ones like SMR as it broke out down here. We bought this breakout back in April. It breaks through right about here. I'm sorry, in May. It shoots up, doesn't close beneath the 21-day moving average until here. So during this massive, 150%, 100% move, it's above the 21. It typically will be in a strong move higher. The third thing to look at is situations where you see more down days than up. Now, if we go back to our initial OKLO example, and I'll turn our moving average off, I typically like to look at a 5 or 10-day period. And if I see more down days than up, I'm probably going to start trimming the stock. Because if you think about it, a stock that is in demand with more buyers than sellers should have more up days than down ones. It is okay to have a down day here, maybe 2 over there. Stocks can't go straight up. But if it's down 4 out of 5 days or 7 out of 10 days, that's kind of tell you something. Now, if we look at the initial burst up here in OKLO, we took some partial profits on that move. You got 1, 2, 3, 4, 5. So 4 of these 5 days in here were all down days. That's starting to show some weakness. Similarly, as the stock topped out over here, look what it did at 1, 2, 3. So 5 of the 6 days are down days. That's a lot of weakness. Now, hopefully, you're going to see this before the stock rolls over. So here you had like 2 down days. This is kind of 1, 2, 3, 4 out of 1, 2, 3, 4, 5, 6, 7. So not looking great in there, but you really didn't start getting a ton of down days until over in here. You got 1, 2, 3, 4, 5, 6 out of 10, 7 out of 10 or 11. So again, this is not an exact science. This is not one you're going to see a lot in these really fast growth stocks. If you're looking for names and you're into the names that are climbing 50 and 80 and 100+%, by the time they're down 7 out of 10 days, you've probably been stopped out already. But in the slower movers that go up 15, 20% per month, look for this. Look for 4 out of 5 days or 7 out of 10 days that are down versus up, usually a good place to be getting out. And then finally, the last thing you want to look for is a high volume day with no price advancement. Now, I'm going to show you an example of that here on Denison Mines, ticker DNN, but this is a bit of a rarer signal. This is like 1 out of 50 times is going to be the reason I sell. And the reason we look for this is it is often a sign that institutions are beginning to exit. Remember the basis of supply and demand. We want more demand and supply, more buyers and sellers. So when volume is rising, the bulk of that should be buyers and the stock should be going up. So if you start seeing above average volume and the stock is just going nowhere, that probably means there's as many sellers as there are buyers, which means the institutions are beginning to get out. The balance of buying versus selling, is starting to shift. And I know there's going to be somebody out there that says, Ross, you're an idiot. Every trade is a buyer. Every trade is a seller. There's always the same number of buyers versus sellers. Yes, that is true. I'm talking about who's being the aggressor. The buyer's going to take the trade on the ask. The seller's going to take the trade on the bid. And if there's more people initiating the trade, being more aggressive, it is going to rise, okay? Now, here's the example I'm talking about, and it's not super clear. Again, this is a little rarer, but here's an example in Denison Mines, and I want you to kind of look at these last couple of days. This was the highest daily volume here on October 7th since June. So this is the highest volume day in 4 months, and look what the stock did that day. Literally nothing. It went nowhere. In fact, we began to see this ramp up in volume here as the stock was just not moving. And sure, it had a little uptick here at the end, but then quickly rolled over and very possibly could do this in the coming months. I don't know what's going to happen, but it is something to watch out for. Big volume, no advancement. Lots of trading happening, stock not going anywhere. The only exception to this and what to look out for is if it is the third Friday of the month. The third Friday of the month is options expiration day, and there's often a ton of volume as options get settled. It has nothing to do with institutions getting in or out of the stock. So take that one as an outlier if that happens on a third Friday of the month. But otherwise, it's another place to sell. So these are my 4 places to sell into strength and 4 places to sell into weakness. And the best traders out there are very good at doing both. They are actively taking profits when things are good and the stock is surging, when it feels like it's going too far too fast, and it's probably a good point to put some dollars back in your pocket. And they're also going to sell into weakness if the stock fails, if the trend comes to an end, if something changes and it turns direction. So in the strength, you want to look for the largest daily run up. You want to look for the highest daily volume move up. You want to look for one-day advances of more than 3 times the average daily range, and gap ups in stocks that are already extended. On the weakness side, you want to sell if a stock hits your initial or raised stop loss. You want to sell if it closes below the 20-day moving average. If there are more down days than up over a 5 or 10-day period, or if you see high daily volume with no movement on the stock. These are in no way a comprehensive list, but these are really the big ones. And if you start looking for these signals to let you know it is a good place to sell, I think you will be surprised at how many times you sell near the high of the move, and how much easier it is to watch that stock come down and hit your stop loss, knowing you already took half or 2/3 or 3/4 when it was up big. Now, if you got something out of this, I'd really appreciate it if you hit the like button or leave me a comment. And if you haven't already, hit the subscribe button down there in the corner. That way, these videos will show up in your feed and you won't miss another update.